What Buffett learned from Graham. Most people think Warren Buffett became one of the richest investors in history because he was born with extraordinary talent. But Buffett himself would probably tell you a different story. He'd point to one man who completely changed the way he looked at money, risk, and opportunity: Benjamin Graham. Without Graham, there may never have been the Buffett the world knows today. But here's the twist. Buffett didn't just copy his mentor. He eventually surpassed him by knowing exactly which lessons to keep and which ones to evolve. When Warren Buffett arrived at Columbia Business School, he wasn't searching for shortcuts. He was searching for truth. Benjamin Graham, already known as the father of value investing, taught him that the stock market wasn't a casino. It was a marketplace filled with emotional people making irrational decisions. That simple idea became the foundation of Buffett's entire career. One of Graham's greatest lessons was intrinsic value, the idea that every business has a real worth, regardless of what its stock price says today. Imagine walking into a car dealership and finding a reliable car worth 10 million naira being sold for 6 million simply because no one else wants it that week. Most people would recognize the bargain instantly. Graham taught Buffett to look at businesses the same way. Then came the principle Buffett has repeated for decades: the margin of safety. Graham believed investing should resemble building a bridge. If the bridge needs to carry 10 tons, you build it to hold 30. In investing, that means buying quality assets at prices well below what they're truly worth. That extra cushion protects you when life doesn't go exactly as planned. Perhaps Graham's most memorable teaching was the fictional character Mr. Market. Every day, Mr. Market knocks on your door with a different price for the same business. Some days he's wildly optimistic. Other days he's consumed by fear. Graham reminded Buffett that you don't have to agree with Mr. Market. You simply decide when his offer makes sense. That lesson may be even more valuable today, when headlines and social media can send markets soaring or crashing within hours. But Buffett eventually realized something Graham had underestimated. Working alongside Charlie Munger, he discovered that buying a wonderful business at a fair price often beats buying a fair business at a wonderful price. Instead of chasing only cheap stocks, Buffett became focusing on companies with durable competitive advantages, exceptional management, and the ability to grow for decades. Businesses like Coca-Cola weren't just undervalued, they were extraordinary. That evolution wasn't a rejection of Graham's philosophy. It was its natural next step. Graham taught Buffett how to avoid losing money. Munger taught him how truly great businesses could multiply wealth over a lifetime. Together, those lessons transformed Buffett from a skilled bargain hunter into one of history's greatest capital allocators. The beauty of Graham's wisdom is that it extends far beyond investing. Every financial decision benefits from patience over impulse, facts over emotion, and value over appearances. Whether you're buying stocks, starting a business, or simply deciding how to spend your next paycheck, the same principle applies. Don't let the crowd think for you. In the end, Buffett's greatest lesson wasn't just learning from Benjamin Graham. It was proving that the best students honor their teachers by continuing to learn. Markets change, technology changes, economies change, but disciplined thinking, emotional control, and the willingness to act only when opportunity is truly on your side, those are lessons that never go out of style.